Happy to connect with you all through this video again. The topic for today is risk adjusted return. The topic itself is very confusing, so please see this video completely to understand why this topic is very important when it comes to investing. This is Sundar from Canary Capital Solutions. So let me explain what is risk adjusted return through a simple example. Now let's assume you have an option to invest in 3 different funds, and the return out of all these 3 funds put together is 100 rupees. To get the 100 rupees, you have option 1 to risk 25 rupees, option 2 to get 100 rupees, you need to risk 100 rupees, option 3 to earn that 100 rupees, your risk is 200 rupees. So which option will you all choose? I think logically we all will choose the option number 1, which is investing 100 rupees and taking risk of 25 rupees. This is simply put as risk adjusted return, which is nothing but your risk should be substantially lower than the return what you make. So this is risk adjusted return for you. So there are few myths when it comes to understanding risk. So the first major myth what I have always found is all investors want higher return at zero risk. I think we all know that this is not possible, but still many of us expect that the return should be higher and the risk should be lower. We need to understand that risk is inherent and not taking risk is the biggest risk in our life. When it comes to risk, you cannot avoid it, but you can plan well to manage it. The next major myth is high risk is equal to high return. I think this is one thing which we would have heard many number of times. But this is the biggest myth anyone can have. As the phrase itself says, high risk is equal to high return. If high risk always yields you high return, then actually there is no risk. There is a very famous investor by the name Howard Marks. He defined it very well. If riskier returns probably produced you higher returns, then there is no risk. Riskier investments are those for which the outcomes are less certain. Let me explain you with a simple example. Let's assume I have only 100 rupees left with me and I don't know what to do in life because what I have got is only 100 rupees and I need to live my life. So I am totally in a confused state of mind, not knowing what really to do, and I was just walking down the street and I actually saw a lottery vendor selling lottery tickets. Out of curiosity, I just went near the lottery vendor and I asked how much the ticket costs. And he said it is just 100 rupees. And then I asked what is the price I will get if I win this lottery. He said 1 crore rupees. Immediately, I felt very happy. Took the 100 rupees what I had, the only 100 rupees what I had, gave it to him and bought a lottery. Thinking that if I win, I will make 1 crore. Okay, this we normally would have seen in many instances. Now let's understand it logically. If I would have understood what is the probability of me winning, then my decision making would have actually changed also. Let me explain that to you. For the 100 rupees you have taken to buy one lottery ticket, the total number of lottery tickets is about 1 lakh. To win that 1 crore money, to win that prize money of 1 crore. That means out of the one lottery ticket which I have, my probability of winning is 1 by 1 lakh, which means at a percentage point it is 0.01%. If I have to put it the other way, my probability of loss is 99.9%. If I would have just applied this logically, naturally I wouldn't have put my entire 100 rupees in buying because my probability of winning is much lesser than my probability of losing. So can you invest your hard-earned money in this fashion of buying a lottery ticket? I think definitely nobody would love to invest in such a way where your probability of loss is much higher than the probability of making a gain. Then how do you make your investment? Naturally, as I said, risk is inherent. You need to take risk, but that risk should be in such a way that it is manageable and you can tolerate that risk. That is where asset allocation comes, which is very critical when it comes to investing, because it manages your risk more effectively than anything else. Now I am going to introduce one very interesting case study on investment to you all. If you have a pen and paper with you, just pick it up so that you can actually do this case study to understand it better. So I am going to give you two options to invest, and you will have to decide at the end of the case study where will you put your money. Will you invest in option 1 or in option 2? You have 100 rupees to invest, and there are two options. And the option 1 at the end of the first year gave you a return of 40%, and option 2 or the fund 2 gave you a return of 8%. Where will you invest? At the end of the second year, option 1 gave you a return of 30% and option 2 gave you a return of 10%. At the end of the third year, option 1 gave you minus 35% return and option 2 gave you a positive return of 12%. At the end of fourth year, option 1 gave you a return of 8% and option 2 gave you a return of 10%. Option 5 at the end of the fifth year gave you a return of 15% and option 2 gave you a return of 8%. Now do your calculation and tell me where would have you invested your money. If you look at option 1, out of the 5 years, except for one single year, all the other 4 years gave you a very good return. Whereas option 2 gave you almost return on all the 5 years, but the returns were much lesser than option 1. So where would have you invested your money? I know you are all calculating, but let me tell you what would be the end outcome. The value of your 100 rupees in option 1 at the end of the fifth year would have become 147, whereas under option B, your value of 100 rupees would have become 158. Hope it is very interesting. Though option A gave you super returns year on year, but one bad year could have actually taken out most of your return. So it is not about taking risk, it is about managing your risk. That is where your asset allocation comes. The option 2 what I spoke about is a fund which manages money through asset allocation, whereas the fund 1 or the option 1 manages money through investing in equity. So now you would have got a fair idea of how to manage your risk. It's not about making higher returns, it is also about protecting your capital throughout the journey. So now we are at the end of the video. To summarize, risk is inherent, you need to accept it and manage that risk. High risk is always not high returns. Consistency of return is more important than spurts of return, and always practice asset allocation. Hope you would have understood the importance of practicing asset allocation. So then the next topic what I am going to come with is again related to this topic on asset allocation funds. So how as investors you can benefit out of these asset allocation funds. That's the topic for you next time. Hope you enjoyed this video. Please do follow our YouTube channel Canary Capital Solutions. Don't forget to subscribe and press the notification button. Thank you for watching.